today's guest speaker, Dennis Wong. Dennis comes from a professional engineering background. He's also currently a full-time investor, and he invests in the stock market as well as real estate. So thanks for joining us, Dennis.
Yeah, thanks for coming.
It's awesome.
By the way, why Dennis the Wong man? Just curious, what's the story behind that?
Yeah. Well, quite often, a lot of people call me Dennis Wong, Dennis the Wong man. Yeah. So, well, it was for my wife actually. You know, on our wedding day, she was like, of course, giving her spiel, and she kind of say, yeah, all my girlfriends, everyone is looking for Mr. Right. I ended up with Mr. Wong, the Wong man.
That's a good one.
So from there, like many of my friends, colleagues or ex-colleagues and clients would say, hey, Wong man. I said, yep, you can count on the Wong man doing the right thing.
Awesome.
Investing too.
Great. Yeah, do you want to go over quickly your disclaimer as well?
Oh yeah, just very quickly, just for transparency and disclosure, I'm not a licensed professional or certified broker or financial advisor, investment advisor whatsoever. I'm an individual investor, sharing my knowledge, my experience, and we're here to learn from each other. Tonight I may mention any of company name, stock, and some of them I may have position, I may have an opinion, but it doesn't mean that I'm telling you to buy or sell. Okay, just want to be clear, and we're all here to learn. Yeah. So.
Thanks.
Okay.
Yeah, I mean, as anything, it's get individual advice. It's a very personal decision for investing. It's the same thing we always say for real estate. We talk a lot about real estate here, but make sure you have a discussion one-on-one. So.
For sure.
So yeah, the 3 legged stools of wealth, right? That's the presentation topic today, and other direction.
The other direction. Yeah.
But yeah, explain to us what's that like? What's that concept for you, and why it's important?
Sure. Yeah, that's a very good question. Again, my personal view, my personal opinion is that for everyone or anyone who wants to do well financially, at least this is how I go about it, is I believe that only a 3-legged stool would be stable and secure enough, right? So financially, it's the same. It's like what we're sitting on. We even have, well, not exactly, but looks like 4 legs, right? So what I'm referring to is the 3 legs for financial stability. Is the first one is capital generation. Right? So we all have our own way to make money, to make a living, right? Through our job, our business, whatever we're good at, our expertise to generate capital, right? So
essentially active income, right?
Yeah, absolutely. So that's of course, the fundamental. That's what we do, I believe, on a daily basis, right? So I would say financially, that's certainly the first leg, right? The second one is, I call it the capital growth, right? How we grow the capital that we generate. So through investing, right? So for me, investing for growth is primarily investing in public equity, or AKA, stock. I try not to call it stock or share, and I'll explain a little bit more later, right? That's how I see it, is for growth, basically participating in some of the global business, owning them, right? That's what I call public equity, right? Equity that we can access on a public stock exchange, and own some of the best global company for growth. So that's the second leg, right? The third one is capital preservation, and the way I do it is like everybody here in this room, real estate, and that's how I see it. And real estate, capital preservation, and also income generation as well. So on top of the preserving capital, because it's real asset, hard asset, and that's how we protect our asset, our wealth, and then on top we get income as well. So that's the minimum. It's not the only thing. So that's what I call.
I know we've discussed this before, but these can be mixed too, right? Because you can have real estate, but let's say you're doing Airbnb or you're flipping. Really, it's more of like the leg of the active income and capital generation, right?
That's a very good point, actually.
It can be mixed around depending on what your goals are.
Absolutely. there's no like a lot of things we do in life is there's no like one clear line that we can draw, right, between the differentiate the two things, and a lot of them they are it's a mix, yeah. And of the three, I'm sure the way I mean that's exactly what I do is like all three of them and mix them, and even within the real estate category, you can have a lot of people debating whether the short-term rental, you mentioned Airbnb, doing the flip, or and I'm sure that many of us here would learn how to or share, our knowledge in creative financing, and there are many ways to manually up the value, right? Create the lifts, right? Refinancing and all those.
Yeah, forced equity and
exactly. Yeah. But the way I personally see it is those are active work. I put it in the business bucket, and
it's like the business of it's a business in real estate.
Exactly, it's a real estate business rather than a real estate investing. The investing part is holding on to the asset for long term, generating income, and let it pay for itself, right? So, and then gradually we increase our equity portion. Right? So that's how I look at it.
Awesome. Yeah. And on the stock market, which I know you consider more of a business investing or investing in business, I know that the main way that you invest in the stock market is through value investing. So do you want to tell us a bit more about that, what you consider value investing and how you underwrite stocks and look at stocks?
For sure. Yeah. So in the stock market, first of all, the way I look at it is that the stock market is just a marketplace. I don't look at it as what I'm investing in. When we talk about stock market, I look at it as nothing different than, Safeway, Superstore. That's the marketplace you go get grocery.
That's where you get the food.
The food,
where you
yeah.
get the investment.
Yeah, exactly. And then go to online, right? Facebook Marketplace or Amazon and all those. And the stock exchange is nothing more than just a marketplace that, hey, when you are ready to buy a piece of a business, to own a piece of the business, you go on the stock exchange, right? To put your order in, and when your orders fill, hey, you own a share of whatever, Apple, Google. So the stock market to me is not what I'm focusing on. I'm focusing on finding the best business, global company that are growing. I'm investing for growth, try to grow the capital, right? So that's the fundamental of how I learn it, and I believe in it, and that's what I do, right? So when it comes to value investing, is a lot of people in general in the markets, if you listen to any of the financial news or analysts, you turn on whatever, Bloomberg, CNBC, right? People always talk about, I'm investing for growth, and there's growth investing, there's value investing, and people so kind of have the perception that the majority of the people are investing for growth stock. But from time to time, when the market is, kind of in a correction mode and everybody is trying to be safe, to go back to the so-called value stock. So in general, a lot of people have the perception that value investing or value stock is the cheap one, right? Nobody wants it. It's just under certain circumstances, that's where you park your money or your investment without leaving the market. But to me, that's not the case. To me, what value investing is very simple. Finding valuable business, right? Company is so valuable, right? So when we drive by downtown Calgary, we don't have to go far, right? And we're all real estate investor here. I believe most of us, right? You look at all those buildings, sometimes you wonder, at least I wonder, hey, who owned this building? It would be nice if I own it, right? Oh, yeah. Well, actually, you know what? 18 months ago, I came across a deal and along with some of my partner. And I don't know if you guys know that the building on 4th and 4th Southwest, the 30 storage with a big sign of Rogers on top.
Yeah. Mhm.
And it was for sale. It wasn't listed, right? So, some of my partner negotiating the deal, it was like very realistic and down to like 13 million for that building, along with the parquet, 3-level parquet, 200 some, parking spot and all that. And then they look into the background, and it was owned by a REIT, and they bought it in like somewhere around 2015, 2016 timeframe for 155 million. Yes. Yeah. So anyway, I think eventually got snapped up by somebody, investor from Vancouver who has very deep pockets, right? So what I'm getting at is that I think we all wonder, wow, look at all the beautiful skyline and all those assets. Who owns it? Would it be nice if we owns it, right? But none of us would have, like 100 million to buy the building or whatever. Like in public equity, a lot of great company, like inside those high rises, you got multinational global businesses have their headquarters, their operational office there, and you go, hey, who owns those companies? We would be rich and wealthy if we own them, right? But in reality, no one individual, other than like some of the family-owned business, like even Walmart, right? The Walton family still own quite significant percentage of it, but not everything. So value investing is about, hey, there's so many valuable business. How can we find them and own a piece of it? And in a private market, we can access it, right? We don't have enough money. But the beauty is the public stock exchange basically is the access point for every one of us here. So we find those valuable business, global business, even when we are having a night here, they are doing business globally and growing and generating revenue and cash flow. That's what I would call it as a valuable business. So
how do you underwrite them? Like, how do you decide which you're going to pick?
Yeah, that's the next step.
Options, right?
Absolutely. Too many options. That's the challenge, right? I would say for me to talk to anyone about stock investing, and sometimes it's rather challenging for people to understand. But I believe for the group here, it's a no-brainer because many of you guys are real estate investor. Many of you guys are familiar with your underwriting process. It's the same. Fundamentally, it's the same process. It's just different asset class, right? One is active business. The other is real estate. So it's nothing more than just, hey, what are the criteria to consider as a great business, a valuable business? There's no difference than when we look at a piece of real estate, a property, I think fundamentally the checklists are very similar, but everybody is a little bit different. On top of that standard checklist would have your own few points, right? Location, transportation, infrastructure, proximity to school, to grocery, to shopping mall, to work location, demographic, and all that. The same thing, right? In business, hey, what is the company about, right? So why are people paying them for their product and service? What are they solving? What problem are they solving? What value are they adding? And things like that. So I think that's where we try to understand it. So understand, just like understanding the property, and then you go, oh, people are willing to pay this level of rent, and etc. So, and then we go, okay, it's a great business, it's a valuable business. So how much is it worth? What is the value of it, right? Value investing. So we, like, again, real estate is the same thing. How much is it worth? So everybody has your way of calculating it. The most tangible way, of course, right? NOI divided by cap rate, right. And then plus all the other intangible. Same thing in investing in the public equity or stock market. So we go through the valuation process, and then you go, okay, once you know how much it's worth, and then you go, okay, I know the value of this company, this business, so I want to own it. This is a very great business. How much am I willing to pay, right? So that's naturally the next step. Hey, if this property is worth $2 million and the seller is asking for $3 million, you go, yeah, as much as I would like to have it, but doesn't make sense.
Do you have like general metrics you use, or do you base it on the type of business, or like?
The
going
general
through that
process
process?
is the same. The
Yeah.
criteria is the same, and quite often actually there are a few tonight here for my investor group, and we go through the process, right? We go through the process of valuation. Basically, there are many different ways, many creative way, and to value business. And I mean, just this past week, the market's value, for example, Palantir, 450 times of price to earning.
Yeah,
That's nuts.
crazy high. Yeah.
And
that's when the fundamentals don't really make sense.
that's what
right?
I'm saying,
Which in some
right?
cases
So
they don't apply.
the market's willing to pay like 200 times of price to revenue ratio, or 450 times of price to earning. That's crazy. But fundamentally, we know real estate, right? Hey, the rent, the expense, net operating income, the cap rates, you can go wrong with it. Give yourself a little bit of buffer of everything, whatever amenity and right, all that. It's the same in stock valuation. What's the earning? What's the cash flow? Discounted.
Does that have to change market-wise? Do you have to adjust your numbers based on the market? And what I'm referring to is the same thing in real estate. So sometimes, if the market's at a peak, but I see a really great property that I know is a good long-term property, and I've been doing this long enough through ups and down cycles. I know it's going to be easy to rent, good to rent. I love to own all of those. I've overpaid for a few, still my best properties. And then I've gotten deals on ones that aren't great. So from a long-term perspective, I'm willing to overpay for a good property. And, what I could get for cash flow at ROI, 4 or 5, years ago here, it was pretty easy to make money putting 20% down. Now that's a little bit more challenging. But would I still buy the same property right now? And sometimes the answer is yes, even though I know it's not a great return on investment now. I'm still putting a valuable, good long-term performing property in my portfolio. So even though I'm slightly overpaying for it now, especially when I compare to when I bought in a different market, real estate is a little more stable. Rents certainly go up and down a lot. They go up and down 30%. But in the stock market, values could go up and down virtually 100% if it loses all its like it can fluctuate a lot more. Do you find it riskier, or how do you manage that? And do you change your metrics inside of a market based on the market is what the market is, and you can't sit on the sidelines forever?
Right. So that's a great question, Ling, by the way. I would say that decision is very personal based on the investor. I mean, the fundamental, we all know how to do it, right? At what point we are willing to, take that risk because the premium is a risk, right? And even the intrinsic value where it is, there's no definitive absolute value. It's all, kind of estimate, right? No matter how you calculate it, no matter how objective you try to stay, there's always some subjective factor. So I would say the bottom line is just like the building I mentioned, right? Obviously, somebody has very deep pockets because when we went through the rent roll, like there are only 40% of tenants or occupancy right now. Yeah, very, very dire situation, right? Some of the tenants with a very old lease, they're paying like $20 per square foot, and then some of the new one, like $5, right? So it all comes down to, hey, over time, just like the stock market, right? It would go up, but in short term, it always go up and down. So it all comes down to, do we have enough capital? Is our pocket deep enough to absorb those? How long would that absorb? I think it comes down to that. But
yeah, similar to Lane's point, it sounds like you'd rather buy a stock or business that has good long-term potential, even if it's not necessarily the best metric.
I would say
today, right?
That's the basic, that's the fundamental. It has to be a good business, a good asset, a good property, has long-term potential. And in business, we call it the durable competitive advantage of any given business, right? Why their product, their services, let's say Coca-Cola, It's been around for a century, right? People buying it, right? Love it, right? So it's very, very durable, long term. So I think that's a given. It all comes down to how much you're willing to pay. Are you willing to, at what point the potential, the probability of getting, what we project versus the risk, right? So we want to find any opportunity that give you the, I would call it asymmetrical, chance of winning, right? So there's always risk. There's always a chance of, hey, things are not going as I want. So how long can I last? So I think it comes down to when you see a deal that you're willing to pay, sometimes it's numbers, sometimes it's a gut feel. And you know what, by the way, actually, there's something that let me do this. Let's do something fun.
Okay.
You guys know how to invest. You guys would know how to make these kind of decisions, okay? So let's do a deal. Has anyone done a real deal here in this meetup?
Like a live deal review?
A live deal?
No, I don't think we've done
No,
that before.
never. Let's do the first one, like a
Okay.
Shark Tank or Dragon's Den deal. I'll show you guys. You guys would know how to make investment decision. I guarantee. You walk away tonight. You do the same thing in any type of investing. You can't go wrong with it. Okay. So anyone got cash in your pocket? I'm not kidding. Serious. Okay. Well, if you got cash, which are okay. If you don't have cash, I'll take handshake. Okay. Well, cash take
Handshake deal.
priority.
Okay.
Okay. I'll trust you guys. Okay. If nobody has cash, I'll take handshake deal. Okay. And then you pay me later. Let me show you this. Let me make you guys a deal. Let me see. All right. Okay. What is this?
$20.
So everybody knows there's a value here, right? That's easy. We don't need to do any underwriting process, and because the government told us that they guarantee this has value of $20. So what if I tell you that this is a very good investment opportunity that I'm gonna sell you, make you a deal? Well, who's that? The Queen. The Queen's no longer with us. So sooner or later, these paper notes gonna slowly disappear and go out of circulation, and the bank's gonna take it back, and probably they're gonna roll out King Charles, right? Right. So it will become someday collectible, will worth more than $20, right? Maybe 50, 100, maybe 10 years,
Who
maybe
knows, yeah.
50 years, who knows? But it will head in that direction. So become very valuable. I'm selling this to you, anyone, for $30. Come on, you investor. Oh, come on, don't laugh at me. Come on, it's a great deal. $30. Anyone? Anyone?
Maybe you've got someone.
I can sell you this for $50.
Oh, there you go.
He's selling for 25.
It's got reversed on you.
He has one, and for those who doesn't have $20, this is okay. You know what? I'll lower the price. 20 for 20. By the way, this number, the one on this bill, the number is really good. It worth more. 8, 5. Okay, let me skip those two. 3, 9, and I think if you're Asian, especially, or Chinese, those are great number. Those number would appear on license plates. When you see those numbers, it's an Asian, the car. 20 for 20. Anyone?
Okay, I'll take it.
You take it.
20 for 20.
20 for 20. You got a deal. See, Shark Tank. There you go. All right. Yeah, see, it's great. She did the deal, and the husband or the partner paid for it. And by the way,
It did work out.
yeah, it did work out, right? So, by the way, the beauty of the stock market is, in real estate, right? We all go, hey, when there's a good deal, everybody's trying to grab it, and then because when the deal is, 20 for 20, is this the same one? Oh, okay. Well, it's like the bank, right? Circling the money around. In fact, here's the advantage of the public equity, because in real estate, once the deal is gone, it's gone, right? This lot, this house, this apartment, this building, or whatever, this piece of land, right? So whoever you think, I'm willing to pay a little bit of premium, while others go, no, I'm not willing to take the risk. I got to have some margin of safety. And then the one that willing to pay, willing to take the risk, grab it, and it's gone. And the advantage of investing in the stock markets is there are millions and millions of outstanding share that, when somebody took the deal, there's always another one, right? And then when whatever trigger, there's a market condition. All of a sudden, I go, hey, it's for sale. It's on sale. 20 for 10, anyone? I'm not kidding.
Now you've got some
Come up here. The first one come up here, 20 for 10. Wow, see?
Oh.
She's ready. She's ready.
Wow.
Okay,
Popular guy now.
you pay me after.
The 20 is on sale.
All right. Okay.
We need a better example, though. I think there's more people willing to take a better deal.
But honestly, that's value investing at work. You know the value of that $20 bill, right? You know it has good value, and you understand the value of it. And then when I say, hey, 30, everybody go, ha, 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 he's crazy. Yeah, he's definitely the wrong man. He's wrong. He's so fucking wrong, right? 20 for 20, what for? Why? Right? So yeah, it may be potential, but the risk of how long do I have to hold on to it? It depreciate. What? Inflation is what? The government said 2.5%, 3%. Double it, even more. We all know that.
Oh,
you
yeah.
walk into grocery store and anything, right? So the risk is higher, even taking the deal at 20. But 20 for 10, no brainer. You run out. So you already know what to do. It's exactly the same. That's what, to put it simple.
Yeah, once you understand the value, you can see opportunity, right? So,
Yeah. So that's it. That's it. We can go networking, and that's it. That's all the talk. Seriously, that's as simple as that. But of course, the complication is the markets. A lot of noise. The financial industry has become so, because sophisticated or very complex and very, very, difficult to navigate through. So it makes it very difficult from finding what is good business to how much it's worth, and then, how much you're willing to pay for, and people willing to pay 450 times of earning for Palantir, 58 times of earning for NVIDIA. I mean, don't get me wrong, great company, both founder-led CEO, absolutely fantastic business, solving problem, creating value. But buying it at that level means you're taking the risk. That premium represents risk, right? But there are always opportunity. Doesn't matter whether it's the stock markets or the real estate market, for various reasons, right? So that's why it's a long way to answer your value investing question. And so we did the first live deal, a real deal here, Shark Tank.
yeah. Some people got the discount, so.
I do like to, I want to just point out what, that marketplace idea. I know it's kind of a simply worded, but the idea of that the stock market is a marketplace, because it gets conflated in stocks when people are investing in paper assets versus in real estate. When you go buy a house, you're investing in the house, the asset. Everyone
It's very tangible.
Nobody thinks, oh, I'm investing in Realtor.ca or EXP Realty. Everyone knows the difference, but everyone's like, well, are you invested in the stock market?
Yeah.
It's like, yeah, I'm invested in the stock market. Oh, I own these companies. But just the mentality of that is like saying I'm invested in Realtor.ca. It's not. It's just actually the marketplace. The real. I like how you look at it as I'm trying to buy a good company, just a piece of it, instead of I'm in the stock market.
Right.
That implies the moving around, and as soon as you try and maneuver and trade, you're going to get not even outsmarted by the big guys. They have all the advantages, the insider trading, everything that happens in the part of the stock market that a lot of us don't like. Is the part that can be avoided if you actually just focus on buying a piece of a good company versus being in the stock market. And it's something that gets conflated a lot, and I've never actually differentiated it in that fashion. So it makes sense.
Yeah, makes perfect sense. What you just said is absolutely true, right? But at the same time, that's why at the beginning I try to emphasize on, I don't look at it as investing in the stock markets. I look at it as like owning a piece of the best company. That when we're like being here, when we're sleeping and going on with our day, and they are continue to work for us. So that's how I look at it. I do look at it as no difference than owning, let's say John Bono, the Italian restaurants on 17, right? I mean, great family restaurants. If the owner say, hey, we're opening up another one, and we're going to let the investor come in and own a piece of it. And I go, hey, I love this business. And
it just happens to be publicly traded, like you said. Yeah.
But it could be a private deal, right? In something like that. But we're looking at it as, hey, Apple, let's say, I'm sure like more than half of the people here using Apple iPhone or Apple everything, right? And you look at it as a business and you're, hey, I don't have $3 trillion to buy Apple, but $250, I can own a share. That means I get to share, the future growth, the earning, the cash flow, the dividends, and all that. And then, you're absolutely right. You have no control because it's an active business. It's not a hard asset. The risk is, if you buy a share, let's say 250, I didn't look at the price. Just for example, again, mention name, don't go to buy it, right? The only thing you can do is, if you don't like it, if it doesn't work out, you sell it, right? You may earn money or you may lose money. It's not a hard asset. So that's why
the difference with real estate is you can go click a button and sell that share in terms of liquidity, right? With real estate, it's a process to sell that property, which can also be a downside because with real estate, you are a bit forced to go through the ups and downs because you can't just sell and buy back, right? So on that topic, what are your thoughts on day trading and people that try to time the stock market?
That's a very, very good question. The market allows trading for a reason because for liquidity, right? So we all have the freedom to go in and out, buy and sell, and as needed. And whether hey, that company we don't see their growth rates can keep up, and then or we have a better company to rotate our capital to, so it's very liquid, right? So that's the advantage. And I think we can compare all night long the advantage and disadvantage between real estate and stock investing. Each one of them has its own advantage and disadvantage, right? Certainly real estate, and some people look at it as higher risk because the amount of capital involved, the amount of capital or equity got locked up, and you can't move it, you cannot easily get out. And
less liquid.
Yeah, not as liquid. The moment you committed, whether it's a single family, multifamily, let's say an A-plex, right? The moment you committed, and if the cash flow didn't work out, and if the market tanked, the lender may come to you for a cash call, right? And everything. Anything can happen. So it could be interpreted as higher risk, right? In stock investing, average people, a few $100s, a few $1,000s, or 10,000 or whatever, right? Anyone can do it, and you can make those decisions, right? But the fundamental is you got to be owning business. Now, trading. Here's how I see trading, right? You're buying and selling a stock. You're buying and selling whatever the underlying security. So the whole idea of investing, that's why I emphasize on, is about, hey, I want to own a piece of a company, an active business, which I believe is a great business, as huge value. And more important, as I mentioned, I consider it the second leg of the stool for growth, for capital growth. it better has growth. So I do have target for any company that I look at or consider, right? Certain, to put it simple, 15%. Okay, I'll explain maybe later why, okay? So it's about finding them, buying it at a discount or fair value or even discount like what we
Like the
just did
example,
before,
yeah.
right? And then as an owner, you want to ride that business to success as they continue to do business revenue, earning cash flow. The value of the business goes up. So ultimately, that increase in value reflect in the share price, right? Now, when it comes to trading, right, you buy in the morning and you sell in the afternoon or before the end of the day or next week or next month and things like that. So I think many of us had tried that. I tried that, and someday we're lucky enough, we make some money, right? Buy low, sell high. Anyone know how to do it, right? Easy, sounds easy, right? But the reality is, within the short time frame, whether it's within a day, when you do a trade within a day, within a month, within a weeks, or whatever, the underlying business that you own, the share that you hold, the business, the real business, hardly ever had enough time to grow its business, to grow the value. So if you're lucky enough to make $10,000 from, open trade in the morning, at the end of the day, congratulations. We all know that as investor, right? To make money, you follow the money. So let's follow the money. The underlying business hasn't grown, hasn't done enough business, hasn't paid dividends, hasn't whatever, right? Where's that money that you just make come from? From another trader. Somebody bought your share, right? So the one that holding the bag. So if you're on the lucky side, when you are the winner, there's a loser. Because every buy, there's a sell. Every sell, there's a buy. So when there's a winner, there's a loser. That's why people refer the stock market. It's a giant casino. It's very true. The majority of it is no difference than, because over 90% of the so-called stock market investors are literally trader. That means AKA speculator, gambler, right? No difference than, actually, I'll show you a chart. So the real growth, long-term growth, S&P 500 is roughly 10%. 10%. Anything above that, like for example, this year, the S&P 500 gained what from April low to now is 30%. So a lot of so above the actual growth, the rest are everybody's money. So let's see who's smart enough to trade to win from the others. No difference than, you walk into a casino, sit down at the poker table, all right? Everybody go, okay, here's all my chips, put it on the table. Let's see who's the sucker I can make money from. And sometimes you look at I know this guy, and you go, yeah, she's not gang up on that sucker, right? And that's, you make money from the other trader, literally, okay? When you cannot spot a sucker around the table, chances are you're the sucker. You're the sucker. I'm not kidding, okay? So that's why Wall Street call, individual investors are dumb money. And by the way, that's another movie in my investor group, in my program. We're gonna watch and analyze that. Has anyone heard of the movie called Dumb Money? One. Okay, great. Yeah. Two. Awesome. Yeah, we're gonna watch that. That was like back in 2022 springtime, the trading frenzy of like GameStop, AMC, Bed Bath and Beyond, and all those, Wall Street bets and dumb money, right? So that's what Wall Street call individual. It is very true. So people think that we all try to trade, to make money. Chances are, if you're smart enough, I don't consider myself smart enough, okay? And I learned from Warren Buffett, Charlie Munger, and their teaching is, we're not smart guys. We're just being disciplined and patient. And over time, we win, okay? So when we trade, we have to think about who we're trading against. Who are we gonna win money from? Who are the sucker, right? Are we gonna be able to out-trade those on Bay Street in Toronto, Wall Street in New York, or Hong Kong, Singapore? No. I don't think so, right? We have our day job, we have our family. So I wouldn't do that. I wouldn't recommend anyone to do that. And also today when we trade, we're not even trading against those guys. We're trading against AI algorithm. All those big firms, they don't even do trade or make trading decision or manually enter trade orders, right? It's all automated AI. Now you will also hear a lot of nowadays they selling you, oh, we have the best AI algorithm. You can subscribe to our service and you'll win. Yeah, you think the AI with like $15 monthly subscription can be better than those by JP Morgan, or even in town here, Morgan Stanley has a big fintech team developing those software. It just a week ago, HSBC complete AI to manage all their fund, their bond trading. So
they have the high frequency trading too, which is just fiber optics lines. So when you trigger a trade, they have a fiber optics line that is a billionth of a second faster than yours. They send off another trade ahead of yours to make the half a penny off each stock you buy. And they do that all day long every day, and they make a spread off of that. So they're just skimming money. So every trade you make, you lose money. Whereas if you buy one stock, they can do that once to you and shave off a hundredth of a penny off of the stock you buy. But if you do it once every 15 years, then it doesn't really add up to a whole lot.
But they do it like with millisecond, seriously, right? Tens of thousands of trade, and there's no way. That's why we are the dumb money.
So you talked about the S&P 500, or you referred to it anyway. What are your thoughts on, let's say someone doesn't have a lot of knowledge in stock market as a marketplace, and what are your thoughts on them buying an index fund versus trying to pick individual stocks?
Yeah, I would say that certainly is a first step. Even experienced investor would typically have a portfolio of mix of index fund and then some company or stock that they have very high conviction, right? And they may own, right? So it's a basket. But I can also show you why index fund is something that also good to consider. I don't have a lot of slides, but just a couple of them. But let me show you this one first before I show you this. The next one is a long-term, 200 years of chart. You don't see this very often. I want to show you that. But before, has anyone seen a chart like this? Has anyone familiar with an M1 money supply? I see one hand, 2, 3, 4. Good. All right. Okay. M1 money supply. Yeah. Welcome, guys. Hi.
There's chairs in the front, by the way.
Yeah, they're chair here. Grab a chair and grab some drink or So for those who are not familiar with this chart, just to share with you, this is an important chart to understand. This one from Fred, that's Federal Reserve Economic Data. So I pulled this chart last week, and then the latest update is October 28th. The last update, okay, so a couple weeks ago, October 28th. So this one is issued by the Federal Reserve Bank of St. Louis. By the way, anyone know or October 28th, the significance of October 28th? Actually, I posted on social media on that day, I posted something about October 28th. That's the 96th anniversary of the Black Friday. 1929, October 28th, the stock market crashed 12% one day. The next day, another 12 point some percent, 2 days, 25%. Yeah. And then it didn't stop. And by mid-November, 50% gone. It didn't stop. It went on for 3 years until 1932, 90% gone. Okay, so that's why value investing is so important, especially nowadays. So we buy business, right? Don't buy stock, buy business. So this one to show you why we need to consider invest in the stock market. It's all about managing risk. It's about owning business. And for some of you, missed the deal. You guys missed the best deal, right? Was there a best deal? Ever seen a real Shark Tank deal in the house? Yeah. So that's why we don't do that as investor, right? It's all about managing risk. So this M1 chart, M1 supply, money supply, it basically, to put it simple, in a very simple term, this showing all the US dollars in circulation globally, including all the money, all the paper notes, all the coins, all the deposit in bank, different type of deposit in cash, okay? All of them, okay? Although this chart only starts from 1959, right? It went all the way to October 28th, right? Just a couple of weeks ago. The significance is here, let me see, right? Okay, along the way, well, the 250 years of history in the US, right? The founding of the US, printing US dollars, all the way to the year 2000. The total US dollars in circulation, $4 trillion. Okay, $4 trillion. A lot of people never seen this chart. When people see this chart and understand what it is, you would know what your money is gonna, what's happening to your money, okay? COVID hit 2020, shut down, right? No business in operation, the economy tanked, and the government tried to pop it up. Not only US government, the same here, Canadian government, Australian, and all the developed countries. What do? Print money. We all know that, right? Nothing new. But how much did they print? Take a look at this. Over 250 years of history, the US government printed $4 trillion. Between 2020 to 2021, shot up to almost $22 trillion. Why our inflation is at 7-8% or 9% in the US now? Those are official numbers. And we all know that, right? We all know how to interpret good news and bad news, right? Good news, take a 50% discount. Doesn't matter how much you understand whatever happened, you can kind of guess that the reality is somewhere there. Bad news, double, triple, 5 times, whatever.
It's a hand-picked basket of goods, right? So, and it changes over time too.
Yeah. So inflation, not only inflation, basically inflation is just a way to describe is the valuation of the paper, the notes, right? So for someone who bought my $20 bill with 20, yeah, the risk of depreciate, right? And for those who bought it for half price, right there you have a 50% margin of safety, right? It may devalue. Well, anyone can argue, oh, it's only 3% inflation. That means the purchasing power, decrease. Or some may say, no, it's double or triple, or doesn't matter. Whoever bought at half price already have 50% of margin of safety. That's how I invest, right? But this chart, what really tell you is that's why if we simply, great, that's why I invest in real estate as well, to protect my asset, my wealth, and that's why I call capital preservation.
There's an edge against inflation, capital preservation. Yeah.
But at the same time, the growth rate is rather slow, because if you look at real estate, and we all learn to play the game of, creating value, right? Using many different ways and things like that. But the true investing portion of real estate investing, at least the way I look at it, okay? My personal view is when everything's stabilized, right? What is the growth? In long term, how much can the growth come from the rental?
Real numbers or numerical?
No, look at it as a business. It's a business.
Yeah, non-leverage. Yeah,
non-leverage, stabilized,
non-leverage,
totally stabilized, right? So, okay, so you're taking revenue, rental revenue, right?
It matches inflation.
Yeah. So basically, let's say, if here in Alberta, we're lucky that we don't have rental restriction, right? Compared to BC or Ontario. So even in Alberta, long term, let's say, is it fair to say year over year long term 5%.
Yeah, we're on 5%. Again, not
5%.
leverage, right? It's
Yeah.
the leverage that makes the return
Yeah,
more interesting. but-
Yeah, that's we find creative way to but I'm talking about passive stabilized, and it's just year over year, right? Everything, right? So the leverage, we've done it in the first time, and then maybe we finance, and all those are, I look at it as active, right? To manage it, to create those value, right? But like a passive investing. So in order, with a 5% growth, let's say average, and then we're looking at this, right? That's what driving the devaluation of our asset, our money. So now with quantitative tightening, right? After the rates hike, right? And then they buying back asset and things like that. Even right now, roughly, we're at 18 trillion. So we're talking about a lot of, devaluation of the fiat currency. That's why we need to invest. And that's why I look at investing as, not just real estate. The real estate is like the later part is to preserve through real asset plus a little bit of income. But if we look at this chart, this one is generated by Professor Jeremy Siegel. He's the head of economic department at the Wharton School of Business, University of Pennsylvania. So the research was done, I believe he published this one somewhere around 2015 or 2016. So with his graduate student and did all the research and pulled all the data. And this one's showing from 1801. So you don't see a stock chart of 200 years of history, right? From 1801 all the way to 2014, basically, showing different asset class. And then $1 in 1801, the value in 2014 is only a nickel, right? 5 cents. So, well, from 10, now another 10 years with all that money printing. This is pre-COVID, right? I don't even know how much it's worth, right? And then showing other asset class, and this is outdated, the gold, right? And by the way, gold is another asset class. And again, I'm talking about the three-legged stool. I'm not saying, again, it's a minimum. There are other, we should build more leg as well, right? Other asset class of investing. So gold, again, the way I look at gold is protecting our asset, our wealth. And real estate generates income. Gold doesn't generate income. The price go up, it's not because the value go up. The value of gold doesn't change at all because it doesn't generate any business, any income, right? So the price go up is nothing more than more buyer than seller. It costs more. It costs 4,000 versus before COVID is less than 2,000.
And fiat
1,500.
currency devaluation, we need more of
Exactly.
this
The purchasing
dollars to
power.
buy the same
Yeah.
thing. Yeah.
But if we look at equity, right, outperform everything, right? Treasury bill, bonds, and the GDP, and nominal, and the real GDP. The real basically is inflation adjusted. So if we look at the real equity growth, 6.7%, right? And plus inflation, roughly, I would say long-term average, 3.5%, that gives you 10% of growth rates. 10% compound growth rates. Now, short term, just like buying the real estate, hey, if the market tank, can I hold on?
Yeah.
Negative cash flow. Am I willing to pay a little bit more premium? Can we, sustain, get through that
ride the ups and
downturn,
downs.
right?
Mm.
So long term, if you have enough capital, deep enough pocket for long term, eventually it will come back up. It's just a matter of how long.
Yeah.
So this long term, this is a 200 years chart, show you 10% nominal growth or 6.7% real growth. And then the other one I want to show is that now, let's take a look at the more recent and more valid today. So this chart I pulled just last Friday. So the last 20 years, right? We're all looking forward. We want to see, hey, let's see how things perform and where things are heading. So this is S&P 500. The last 20 years from 2005 all the way to last Friday, November. Okay, 2005, 1180. Right now is 6,700. Total growth, 468%. Divided evenly over 20 years, average is 23% per year. But we want to be an investor. We're investor. But we don't look at those numbers just on the surface. We say, hey, that's not the real number. We want to look at the compound average growth rate, year over year, compound average growth rate. It's growing at 9.2%. So it validates roughly 10%. So it validates the chart before, long-term growth rate is still true, roughly 10%, right? So this is including inflation, right? So the stock market in general, S&P 500 is the 500 best company, largest company, not only US company, but international company choose to list on the US stock exchange. So the S&P 500, including those on New York Stock Exchange or Nasdaq, right? So the top 500 company, that's the average growth rate. So as investor, we want to look at data first, right? So okay. Yeah.
If we cut this chart and started it at 2009,
yeah,
what the rates would be?
2009, you mean? Oh yeah.
2005.
So it would be even higher, right? It's because
It would be worse actually, because the value now.
At the peak he's referring to.
if you look
At the peak,
Yeah.
yes, but you
Yeah.
also had less.
you can
growth
choose
before.
any year. You can choose this peak and it will be worse. You can choose this trough and it would be much better. You can choose anything. But we're looking at long term. Now,
That's when you buy. That's the rate.
of course. But we know that, that's why I'm saying that the 200 years of chart. And then you can also see that the dot-com bubble, right? The internet bubble right here. Now, if we look at a chart like this, it's just a blip, right? A blip. And this is the Great Depression, the one that I just mentioned, that the 1929 and the Great Depression, that the Black Fridays started, and then So I think the point is, let's say if you start from 1999, and that was another hike, another peak, right? So the return won't be as good. But the point is long-term growth, roughly 10% S&P 500, like 200 years or the last 20 years. And of course, if you take this to start with, it's less than that. If you take this point and 2008 and 9 during the subprime mortgage trigger, global financial crisis, wow, we have grown a lot. That's why for value investor, that's when you buy the $20 bill with $10, right? So we find business like today, the market is crazy, right? So we all have FOMO. So the way I see it is, hey, this is a time to spend time to understand it, to do your research, to do your, like in real estate, like the underwriting process, right? 1 company, 2 company, 3 company, and then you have your watch list. And are we timing the market? We're just not willing to pay the premium and holding the bag, take the risk, right? We want to buy real estate for fair value or even discounted value. So there are always, what I'm saying is that there's always these moments, right? These moments. We don't know when. I don't have a crystal ball. But when it happened, I know exactly how much a company is worth, a per share worth. And then when I see, hey, is somebody selling the $20 bills for 10, right? That's exactly, it's the same thing.
So I know.
How do you differentiate, between the companies that their shares are overpriced or overinflated? Like, for example, Tesla has many times that they are above the real value.
Yeah. I mean, that's a great question. The simple answer is calculate how much it's worth based on real business, right? Based on earning, cash flow, free cash flow.
Is this information available?
Yes. Now, if you subscribe to some of the professional websites, and Wall Street has many of them, but there's so many different type of investing strategy and pricing calculation, and that's why people go, this is way too complicated. But the moment we learn the value investing, that's why I stick with that. That's why I did that deal, to show everyone that you can do it too, right? So there's a process to find. So the dollar bill, you know it. This is how much it's worth. But then here, You have to find a great company, and you're convinced it's a great company. It will continue to grow, and it has all the competitive advantage, very durable, very sustainable. And then, well, basically, to put it simple, I think there's a few from my investor group tonight. In my program, I basically guide everyone to learn how the Warren Buffett way of valuating business, basically, just like our underwriting process to evaluate a piece of property. And then once you know, there's no absolute value, right? So you know what the fair value is. Then you go, hey, you can make that decision on how much I'm willing to pay. So that's the key. By the way, the other one I want to show is a Nasdaq, right? Technology, right? So explosive growth, and nowadays even AI. And before we start, and somebody asked about, hey, is it a bubble? I mean, it's like everything, every glass of beer, there's always a good part, and there's always some foam and bubble on top, right? And the more you shake it, or you pour it, and the more foam and bubble, right? Now the market is, everybody is going crazy, and
Making
then there's
bubbles,
more. Yeah, but there is good substance underneath. So it's just a matter of where to find it, and how to find it, and how to differentiate and understand it, and how to calculate the true value, and then only pay $10 for the $20 bill. That's it, right? So Nasdaq, if you invest index fund, actually it's a long way to answer your index fund.
A follow-up question on what you're just saying. When it becomes a $30 bill, do you sell it? Like, are you selling right now and taking profits from an
That's
Nvidia
another.
or
That's another good.
At what point do you've got a buy point?
Mm-hmm.
The idea is to buy and hold forever. And
Yeah.
in real estate, we do that because the transactional costs are too much, and real estate does not fluctuate as much and can't get that. It can get pretty frothy, but by comparison to stocks, not even close.
Yeah.
Do you have a point at which you're like, this is way too high? I'm not owning this anymore.
Yeah. The simple answer is there's no definitive way that this is when you should sell it. I would say the most important is understand your investing objective, right? That's so important. What you're investing for? Investing for your dream car, your dream house, for your wedding, for your retirement, for your kids' education, for your own bucket list. That's very, very important, because there's no better time or better way to sell it. I can tell you that a lot of, from personal experience as well, selling it because the price went down. Okay, I need to cut loss, right? And sometimes you go, oh, I'm glad I cut loss and it went lower, right? And times that the moment you sell, it went back up, and then, right? Okay, and then let's take the good scenario, right? You pick the right company, to pick the right stock, and got in at the right price, and then it went up. Man, I made some money, right? And then I can tell you that the moment you get out, it's so hard to get back in. Very hard to get back in. The moment you sell, there are moments that you go, oh, it went down. It went down. Oh, I'm glad I sold. But there are also many chances or moments that it continue to go up. You go, damn. So it's very, very difficult.
So to shorten your answer, you're saying, don't try and time the market. You're saying I don't have
Spend time in the market instead.
You're like, if you need it because you're paying for your daughter's wedding, or you need it because you have another use for it, and that timing comes up, sell then, because you're not smarter than the market.
That's what you are investing for, right?
Yeah.
Hey, it's time. I'm finally getting enough for down payment for my dream home, right? It's about time for me to check off this bucket list, right? Life's too short, right? I may have all the money, and next year, who knows what, all of a sudden my doctors tell me something, right? So, hey, there's no better time, right? I would say my rule of thumb is, if the business is still doing well, that's why we spend time to go through that, to build a thesis, investment thesis. Why am I investing? Why do I want to own this business? understanding the business. I still want to own it, and it's continue to grow. And if I can show you any chart, let's say if you own Shopify, right? I'm sure some people own Shopify, and it went up, went down, and now a new high, right? Back to the 2022 high. Is it a good time to sell? Is it a good time to buy? Hard to say. But if you have high conviction with the company, with the business, and you're the proud owner, and you believe they continue to do well, there's no reason to sell it. There's no reason if Buongiorno still like people are lining up and coming in, and unless you can, hey, it's about time I need some money to do my things, and otherwise the market go up and down, and if the business is still good, I would hold on to it. And that's, I mean, like Warren Buffett has been holding on to Coca-Cola since the 1970s. American Express as well, right? And the way he looked at it as, why do I want to sell it, right? Coca-Cola served 1.8 billion serving per day globally. Anything happen, all they need to do is to adjust the price by 1 cent. 1 cent times 1.8 billion per day times 364. And that's $800 million. Go right to the bottom line. Why do I want to sell it? Right? Okay, yeah, maybe I'll sell a little bit, for my vacation. I don't need to sell the whole thing. Right?
Mm-hmm.
Yeah, the moment you sell it, even though you make money, and chances are it's hard to get back in. Yeah, so, yeah. In any case, index fund, if you're buying the S&P 500 index, that's long-term 10% growth. I think that's what I'm getting at without picking stock.
Yeah.
If you are also buying, let's say, the Nasdaq QQQ, for example, again, I'm not promoting anything. I have no association with Spider. So that's the top 100 company, right? So that's what you're getting at. Anyone? Oh,
I'll let you finish. Then.
Go ahead.
In the stock market, is there a way similar to investing in real estate where you can refi and pull some money out? The question was, when do you exit? It's like, it was $100 grand when I went in, it's $1 million today. It's stuck there unless I liquidate it. The thing is now I'm paying capital gains on $900,000. When do I call it quits? And do I really want to get off this bus? It's already gone up 900x. I want to stay on the bus. So in real estate world, we'll refi, pull some capital out, and spend that money, do something with it.
Yeah.
Furthermore, there's cash flow with real estate as well. So at a certain point, your cash flow goes positive, and it's because your mortgage payments are lower. So is there a mechanism? Is there an end point where stock can also give this the twofold return where you can refi one, pull capital out. Number two, cash flow positive. Is there in this world?
Not as many tools as in real estate. Yeah, that's no question about that, right? So that's why you want to stay in and ride it and let it compound, rather than unless you really want to spend that money. And the moment, that's one disadvantage. The moment you want to rotate your capital to another company, let's say, you do have to sell, and then it trigger capital gain, right? It trigger tax. And now I know that in the U.S. There are more to, like if it's a business, and if it's an investment fund, if it's a partnership, a private partnership. In Canada as well, but definitely not as many tools as in real estate. But the way I look at it is that understanding each one, real estate investing and stock market investing, what the rules are and all those taxation implications. And then you just play within that rule. It's not about, which one is better than the other. They all have, different asset class, doesn't matter whether it's gold, bonds, crypto, real estate, and stock, has certain advantage, disadvantage, leveraging, and something like that, right? So, yeah.
Can I kind of answer his question in a different way?
Yeah, yep.
Dennis has to be kind of sensitive about how he answers these things, but for people who have large stock portfolios, one way to pull lots of cash out of your stock portfolio relatively tax-free is you get a loan based using your stock portfolio as a Plus collateral.
Yeah, you can pledge. Yeah.
Right? And so there's people who will invest part of what they take out that way and then reinvest some of it to make sure, so that whatever their asset they're buying pays for the interest on the loan.
Yeah. I think those are, I look at it as optimization. Just like when we choose stock in our process, and once we've gone through all that so-called underwriting or stock analysis, right, and understanding how much it's worth and buying it at whatever price, and then we look at the technical analysis, right? We look at the stock chart and all the technical indicator to predict, hey, what is the probability that it would continue to go up or it would come down, and even though it's undervalued, even though it's hey, $10 for the $20 bills, but it looks like it may go down even more, right? So we optimize. So those are, I look at it, that's the optimization tool, right? And or option trading, right? We do option trading as well. Even though trading, I said I don't encourage it, but once you understand what those derivatives are for, what the tools are for, once you understand what they're for, you're using it for its purpose, not for making short-term money, then you would make money. It's funny how it works, right? So when I tell people that every month, my monthly option contract never lose, and people go, yeah, I BS. I say, okay, well, spend some time with me. Let me show you. So those are optimization. There are many ways to optimize. So in stock, I use option to optimize, and I make money before I even own the stock. And
So how do you use those options?
Oh, wow.
I mean,
how long do we have tonight? We can go until tomorrow. I can talk all night.
Okay.
No, to put it simple, option is nothing more than just like an insurance, right? They're fund manager. They want to protect their clients' asset, to put it simple, right? They want to hedge against the downside, so they pay a premium to buy the right to sell, let's say, a stock at so-called strike price. No difference than what we do in paying the insurance company premium to insure our house or our car if a certain condition is met, right? Whether it's hailstorm or somebody hit our car, and that's the strike price, and then they pay us, but we pay them premium, right? So here's the funny part, right? So you guys bought the $20 bills for 10, right? If I know that that's the $20 bills, that's the value, I go, hey, you know what? I'm willing to obligate myself if the price of that dropped to $10, I guarantee I'll buy it. But if you want that guarantee, you pay me a premium. So I'm selling insurance. That's the put option. Why people willing to pay that? If I'm a fund manager managing, $500 million under my watch, I want to make sure that whatever. Right now, look at this peak. We all live in a universe of cycle, right? 24 hours a day, 30 days a month, and 4 seasons, and right, ice age, global warming. Doesn't matter what. It's all human behavior. That's the universe we're in. Go up and down, up and down. I don't know what will trigger the next one. It will go down. It may go even higher. It may go up to here. Right? It's not the money that I want to make, right? So it will come down. So that's when fund manager go, hey, I want to buy the insurance. Okay, I want to guarantee that if NVIDIA dropped to $150, and I did sold some NVIDIA put option last year. Oh, okay, try to avoid talking about that. I'm more than happy to buy at this price. So I guarantee them they pay me a premium. So I'm waiting for the $20 bill to drop to $10. At the same time, I'm collecting money for those who want the right to get out at $10.
And an insurance company might want it because they know they have a certain amount of people that die in their life insurance policy, and they have to pay it out. So they might want a very consistent cash flow, so they're willing to do it on one end. Or I mean, I've traded, but only for insurance. I'm on the other end of that trade where so heavily invested in real estate in 2014, I wanted the right to, I basically bet against Alberta oil and gas. Not that I thought it was going to go down. I had no inkling that it was going to go down, but I bet against it because I felt that my leveraged portfolio of real estate was essentially an oil and gas bet, which it is, or at least was at that time with our economy so wrapped up in oil and gas. So I wanted to know that if everything crashed, that I still had, that I'd get payout a few $100,000. It would cost me a few $1,000s a month, which I could buy a few more properties with, knowing that I didn't need a cushion, use that cash flow to spend it on $2,000 a month for an insurance policy that would have paid me out $250,000 if everything crashed. And the market continued to go up for a while. My broker did not like me losing money every month because that was the only thing I wanted to trade. So I stopped doing it at some point, but when the market did correct, I just had enough cash at that point, but I'm on the other side of that trade. So options.
Yeah, Jane, the downside, right?
Yeah.
One thing happened, you make money, the other happened.
Yeah, so it's I was just on the other side of his trades essentially. Maybe
Exactly.
Maybe I paid you $10,000.
I think we have a question there.
I'm curious how concentrated you are in your stock portfolio. Meaning, like, how many positions you typically do? Is it like 5, 50, or?
Well, no, not 50. I would say probably somewhere around 20. But I also have other private partnership that I'm managing. So I think the key is if you are into investing of owning specific company, the way I learn it is, this is what Warren Buffett how he teach, right? He said, consider if you want to invest in stock, right? Because the whole philosophy is you're owning the business, you're investor owner, right? So in order to own any business, doesn't matter, he also said, even if you own one share, let's say if you own one share of Apple, you have to consider, yourself owning the entire company. That means like understanding the business, following and all that. You can imagine, right? Other than professional, they have, departments of analysts and they have all the resources, right? But for us as individual investor, we probably don't want to own 20 different restaurants, right? Because even though you're not running the business, but it takes time to go, how are they doing? Where they make money or lose money. And,
what you're saying is understand really well what you own rather than buy a bunch of stuff you don't really understand.
Exactly. Yeah. So what I would say, the short answer to your question would be, I would highly recommend anyone, individual investor, if you're interested in owning the best business and get involved in this game, is don't pick too many. That's not diversification, right? The best way is only invest in those companies that you have very high conviction that you definitely want to own it for a long term, right? 10, 20 years and ride it. And at the same time, you can buy S&P 500, you can buy Nasdaq, ETF. I think back to your question, basically. So let's say Nasdaq, the last 20 years, roughly 13.6, give and take 14, right? So anyone know the rule of 72 here? I'm sure many. Oh, a few, only a few? Okay, yeah. Okay, rule of 72. Divide 72 by the annual compound growth rates, and that's the number of years that you would double your money, right? So at 13.6, 72 divided by 13.6, right? Roughly 6 years, give and take, right? So you double every 6 years. So just buy the index fund at the same time. Start with 1, 2, whatever you can handle, right?
Right.
But yeah, so that's what I would say.
Awesome, thanks.
Yeah. So, yeah, so.
Would that be the same for, like, if you're doing like cash secured puts or naked puts? Are you still only doing it on like the 5 or 10 companies that you're looking at? Or
Okay, that's a good question. Again, without getting into detail, I don't do any naked put. Now, for those who are not familiar with it, is that if you trade let's say you short put option, right? And if it hit the strike price, you better have the cash to close your the contract. So naked put means you don't have the cash. You're just betting on it, so hoping to make money. So 90% of the people in the stock market, in the option market, guarantee lose money, dumb money, because everybody here from here, there, and then try to trade and leverage and naked put without the capital. the moment they, hit the key, the order, right? The next thing is hoping, praying, and wishing.
Yeah.
I tell you, it's investing. It's hoping, wishing, and praying is not the strategy. So what I just show you, buying the $20 bill for $10 is what we do. So the way I do option is I find a good company. I know it's worth $20. I'm prepared to buy for $10. And then I would short the put with a $10 strike price. And there's also a process how I calculate that when the market price at certain level, that would give me the reasonable return worth my effort. And because at the end of the day, great, I make money month after month, but I have to pay tax. It's not even, if it's not good enough, not even worth my, accounting costs and all those, right? So there's a process. So I do secure put for the purpose of owning the stock at $10. And when the price went below, fund managers go, I need to stop loss at $10. They want to pay me the premium. So before I own the stock, I'm already making money. I can do it month after month after month, making money without losing. And by the time the market tank, I get to own that stock at $10, half price, to put it simple. So you asked the question, extended what I plan to talk about tonight, but that's a very good question. Yeah.
Something you mentioned when you guys were talking, for your real estate portfolio,
yeah,
or at least a part of it in your portfolio, do you buy real estate without leverage, without a mortgage?
And
No.
can I attack in something more to Larry's question?
Sure.
At the same time, can you quickly share what your real estate portfolio looks like?
Oh, okay.
But answer this question first.
I think for me, my real estate portfolio here, compared to many of you guys, I'm a newbie. So I started like everybody else, right? Back in 2013 ish, one unit, single family, townhouse, and one by one. But nobody buy. Well, I shouldn't say nobody. I don't buy real estate without leverage, right? That's not how to invest in real estate. And then now I also get to the point that, hey, what's the way to scale it? And then of course multifamily, and I start coming to meetup like this and going to conference and learn from other people. So right now, to your question, working on some smaller multifamily and looking also, working on a couple of 40 units, and then another one I went to is at the face of underground parking foundation, and those are 100 units project. Some project I involved in like passively, some actively playing an active role. So, but still learning along the way. But real estate always the game is leverage. Right?
Have you ever compared your levered returns with that of your stocks? Because I would imagine that, like in real estate, it's one of the only vehicles where you can get like 5-to-1 leverage, sometimes even 21 leverage.
When you compare it that way, it's not a apple-to-apple comparison, right? Real estate always wins. That's why we all invest in real estate, including myself. So what I'm getting at is that real estate, the way I look at it is, is capital preservation, is a long-term investing, is accumulating asset, stable income. But I want to participate in the global economy, owning global company. You can imagine that, for example, right? Even forget about Nasdaq. Let's take a look at S&P 500. When it's growing at, let's say, 10%, the largest, best 500 global company growing at average 10%. So the way I look at it is, wait a minute, how statistical goes? Normal distribution curve, we all know, right? So chances are a 10% average annual growth or value increase. That means roughly, let's say 200 of the 500 companies are growing at that rate, right? Between, let's say, 8 to 12%. So give you an average of 10%, right? And then maybe another 100 company is below average, somewhere between maybe 3 to 8% underperform. And then maybe another 50 company are loser, total loser, right? Negative earning, negative cash flow, right? So, but then above average on the distribution curve, if the average is 10% growth, that means there are companies growing at between 12 to 18%, another 100 company above average. Some are doing exceptionally well, such as NVIDIA has been growing at like north of 70%, and last year was like 50%. And this morning, CEO of AMD, Lisa Su, on live interview saying that she's forecasting and providing guidance that AMD will be growing at around 35% to 2030. 35%, you double your money divide 72 by 35. That's every 2 years, right? Assuming that she can deliver, right? So I'm investing in a stock market by finding those above average. So one way is buying the index fund. We get the average, say 10%, give and take. But if there are 100 companies above average, right? It's not that hard to find company growing, value increasing between 13 to 18%. So I target somewhere around 15. So I don't want those high growth, right? There are another 50, probably north of 20%, like unicorn and all that. That means more volatile. But I look for mature with track record, predictable, consistent, and very, very wide and deep business modes. And those are the companies that I'll find, I study them, and calculate their value. And then wait for the moment when it's for sale for $10, for $20. That's how Warren Buffett invests. That's what value investing is about. Yeah. So that answers several questions. The index fund, the concentration, and all that. So the easiest way I would say for everyone is to budget yourself, invest in the index fund, and at the same time start finding those great companies, right? North of 15%, find them, identify them, study them, and calculate their value, and understand, and then say, hey, this is how much I'm willing to pay to not to take risks with the margin of safety. And then when the moments come, we're not timing the market. We just refuse to pay the premium and take the risk and participate in those trading fancy gambling, period. Yeah.
Okay, last question. Go ahead.
Okay. This is just a follow-up question of what you just said. So I'm wondering, after you've done your research and realized that this company is good and has all the points that you need, and this is what I want to invest in. I want to know how long, because you want to wait until the price goes down. What's the longest you've waited in a company, before you actually?
You mean real example?
Yeah, well.
Okay, there's one that you never know. Okay, I wouldn't say don't use it as a reference. The funny story is that I found company scanning. I found something that I was looking for real estate business, right? And then I found this one. Hey, I own a lot of land, but it's not in the real estate sector or industry. It's in the oil and gas. So that was 2017. Anyway, long story short, great company. I look at it and wow, very minimal, no debt, zero debt, right? Balance sheet, excellent. Very minimal asset, very light, fewer employees, but earning, cash flow, compounding, north of like 15 to 20% growth year over year. And it turned out to be in oil and gas in that category, okay? Because they own all the land and they have the right to collect royalty. That's a deeper story. I can tell that story, and but probably not tonight. In any case, calculate the value, okay? $700, my valuation. It was traded at 900. Nope. Warren Buffett's teaching, being disciplined. Nope. Literally waited until I had no idea. Anyone remember 2020 during the COVID shutdown? Oil price minus $30, $33 for what, 2 days? Before that, it went up to like 1,300, 1,400. And I go, yeah, between 2017, 2018 to so almost 4 years. Right? So I followed that company. It went all the way down to $230. $230 during the COVID, right? I was just as scared as other investor, and I don't know how deep it would fall. So I waited until it come back up to 300. I started buying 300, 400, 500. So it was like, and I sold some last Christmas. Took my family on a vacation trip, right? Just hey, that's how much I need for that trip. I'm still holding on to it. So I sold it at $27.50.
And so to be clear though, too, you're like, I think part of the question you're asking is, are you watched that company for 4 years? You liked the uniqueness of that, where that you felt some value was there, but you didn't sit on cash, doing nothing with cash, waiting to buy that company.
Okay, that's another good question. Yeah. You always allocate some budget, right? And get ready. You have to be ready.
Yeah, you need
right?
dry powder.
Yeah, dry powder. And then there are other ways to park your money. And you still have a little bit of income, right? Whether it's GIC, whether it's short-term treasury and all that, right? You can also buy gold index fund, right? That preserve your value, but it's very liquid. Right? You don't need to buy the actual gold bar, right? So you can actually buy, let's say, GLC, the fund actually own physical gold and things like that. So you can, very liquid and all that. So to get yourself ready. Yeah. So yeah, certainly you don't want to have like cash doing nothing. And so you always find a way to do that. But being patient, so you just study and have you don't have time to do professional 50, 100 company, but you have whatever you have time, you start building your watch list, right? Just you don't need to spend much time. Like every quarter when they release earning report, have a peek at what's going on. Are they still on track? It's the same in line with your investment thesis. The business still is the same, right? If not, what happened? And have that understanding. And so that's why I said the business that you have the interest is very important. So,
are you willing to stick around for us for?
Oh, absolutely.
Perfect.
Absolutely.
Awesome. So tell us how we can get in, or how they can get in contact with you.
For sure. Okay. Actually, I want to touch on this to show you, okay, how real is investing in the stock market. Well, I'll show you guys how simple it is, right? The not easy part is because of the market is so noisy, right? If we ignore all those, as I said, don't go to the markets. The market is when you need to buy something, right? So don't even look at it. Just focus on finding good real estate, right? So look at Warren Buffett. For anyone who want to know, so how well can value investing perform? So, this is the last page from every year. Warren Buffett, he sent a letter to shareholder. I get this, usually about 15 page. And the last 2 page here, he would add another year of performance comparing to S&P 500. So if you want to see a track record, nobody has longer investing track record than him since 1965. So exactly 60 years. 1965, Berkshire Hathaway's annual performance versus S&P 500. Without going into detail, all the way to 2024. This is from the letter to shareholder earlier this year. Okay, just look at the bottom. I blow it up and for everyone to see. Okay, so he shared this letter, and I went to the shareholder meeting annually in Omaha, Nebraska, and a few actually from my group this year went there with me as well and to experience it. And by the way, value investing, very conservative, very old-fashioned, and everybody's trading and making money in trading tech stock or option. But we are the few, old school stuff. But guess what? If you go to the annual shareholder meetings in Omaha, over 40,000 investors coming from all over the world, not professional, family, kids, learning, following this method. Why? Look at this. At 19.9, give and take 20%. So that's what Buffett. I won't aim for that because he's the legend, right? So again, another proof. He's tracking the last 60 years S&P 500, 10.4 annual compound growth. If you buy index fund, it would double every 7 years, right? Rule of 72 at 10%. So over 60 years, 39,000% increase. But the few percentage difference, if you buy the index fund versus picking the right company growing at 15% or more, and he's doing 19% or 20, 5.5 million %. You'll be amazed how many people I met at the shareholder meetings. Some of them started investing with Buffett back in the 80s. Now, multi-millionaires and some billionaire put their retirement fund in it. Now, again, I'm not advocating you to buy Berkshire share today. I'm a shareholder, okay? Just to put it simple, we said Warren Buffett, nowadays Berkshire, they're holding $382 billion cash and equivalents. And he's not even buying back the Berkshire share. That tells you he doesn't think today, even at today's price, give and take $495 per share, is a good buy. It's a good price to buy. Okay, so I'm not telling you to buy. But for Berkshire shareholder and following him or using his method, that's how I invest myself. I invest in him, in the Berkshire, 5.5 million %, at 20% a year. So finding company growing north of 15% in the S&P 500, it's not that hard. At least there are 100 of them. That's all I'm saying. Don't go for 100, just find one or two.
Oh, we don't have time for questions anymore, sorry.
One quick one. What are the best stocks to buy right now?
That would do
sure you
you
won't answer
more
that one.
harm than good, because I can tell you what to buy and you won't know when to get out. That's the problem. Okay. So again, the best stock is the one that you feel strongly about, you want to own in the next 20 years, 10 to 20.
If you were to tell us which one.
I'll tell you one. The best investment today, we're all doing it right now. Invest in ourselves to learn about it. Seriously. That's the best. The best stock is, is your name. Absolutely.
One quick one. Penny stocks. You ever mess with penny stocks?
No. I don't. I'm not saying that they are bad. I mean, every company deserves a chance, and they are very early stage, very risky. Okay, very, very risky because they're not proven, right? A lot of them, they don't have cash flow, they don't have earning, period, right? So, but there are many investors in the marketplace. They're like, you go to PIMCO, right? They're the largest bond fund, right? So they buy the riskiest junk bonds, right? There are many investors. There are investors want to buy penny stock, but not me. I wouldn't recommend it. So again, that's Buffett, right? Be fearful when others are greedy. Right now, the market is very, very greedy, right? Be greedy when the markets are fearful. And when everybody is, when somebody yells fire, running for exit, dumping everything, cutting loss in the name of cutting loss, that's when we back up the truck, right? Load up those $20 bills for just 10 or even lower. As I mentioned, that company, trading at the 12, 1300.
Yeah, and right now, for all of you investing in real estate in Calgary, think about that quote and sit with it, because I think it will be quite relevant over the next few months, few years.
Right. And in fact, to flip this one, and he also said, we buy fear, we sell greed. So so that's another way to put it. So I always like to quote this on the $100 bill, US dollar bills. That's Benjamin Franklin, right? Very, 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 very simple. He said, fail to prepare, prepare to fail. So it's very simple. right? The market will do what the market does, and then if we fail to prepare, fail to understand it from that first chart, the M1 money supply to the long-term growth, and prepare ourselves. If we don't prepare ourselves and learn about it, we basically unintentionally, without even knowing it, we are actually preparing ourselves to fail. If we look at that M1 money supply chart. So we think stock market is risky. We don't invest in it. We are actually preparing ourselves to fail, right? Because investing in stock market is really owning global company, participate in the global economy. That's how I look at it. So yeah, if anyone wants to connect with me, yeah, stay in touch. And I quite often I update my investor group and my whatever audience. And I don't have time to do a lot, unlike other social media influencer. But I try to do post things that are relevant, like I mentioned about, right, the Black Friday, October 28th, I share as a reminder. And August 15th, I always remind us when the U.S. government, abandoned the gold standard, unpacked U.S. dollars from gold, 1971, right? August 15th, that's when President Nixon announced that. So very important. So if you want to connect with me, yeah, LinkedIn, Facebook, whatever, and that's my webpage. And yeah, have a more than welcome, more than happy to share.
Yeah, and tell everyone too about the movie night going to be co-hosting.
Oh yeah, yeah. So like in my investor group, we take learning. We make it fun, right? So so in the program we learn about investing, and in the process we have quite a few movies to watch, and those are all real life movie, right? True story based movie. I think a couple of weeks ago, was it last week or a couple of weeks ago, we watched the Blackberry.
Last week, I think.
Last week, yeah, we watched the Blackberry. So that was the first time I actually opened it up to, hey, let's welcome everyone and watch the movie, have a fun time, and talk about what we can learn from it and how to apply it to investing, right? So that was following the week before we had a webinar on how to invest in AI and technology companies. So we watched the Blackberry, well, the Canadian darling, right? Ruled the smartphone world and then got destroyed by Apple. So coming up, we're going to be watching The Big Short. How many have great?
Yeah.
How
I'm
many
sure with the real estate?
How many of you guys watch more than one time? Okay, more than 3 times. Yes.
Wow. Read the book.
Yeah.
Yeah. Oh, got one.
No, it's a great movie.
The book's better.
Yeah, we figured, it's one where I think we can take strong lessons for investing in general, like real estate, stock market. So we'll be co-hosting that event.
Combined one. It's a stock market and real estate.
Exactly. So we don't have an official 100% venue yet, but we'll be announcing.
We set the dates, and mark your calendar. We tentatively set it on December 4th.
Yeah.
It's a Thursday night. So we're going to get together and watch the movie and have a post-screening discussion and talk about the real estate market, how the subprime mortgage work, and how the credit default swap and how it works. And it's like option, the market betting on it, buying insurance, right? And then what we can learn about it and how we can make observation from, hey, what is the market today compared to back in 2006, 2007, right? Why those guys are betting against the market and they stumble upon and that's another thing, right? They don't just make the bets, they study it. They study it, right? And then they know what they should do.
Yeah, so if you guys want to join, we'll both be posting about it on our own
December
network,
4th,
so,
I either here or at the Boulevard and downtown condo at the Sky Lounge.
We'll send out
either we'll send out detail. Yeah.
Well, thanks a lot for coming.
My pleasure, and thanks for
you.
having me.